Origin Clear is a company that focuses on wastewater treatment.
And hello, everyone. Welcome to the Water's the New Gold CEO briefing. Our mission is to transform the water industry.
Decentralization offers us this opportunity.
The plan that you've built here is super impressive.
The world is experiencing a crisis in regards to water. It's a great opportunity that you are giving us investors.
The decentralization of water treatment means that we no longer need to establish giant water treatment plants.
Let them fight over the 20%. Let's work with the 80% that's untreated.
Over 21,000 unique alternative investments.
3 million jobs in the U.S. alone.
Making it easy for the regular investor.
All the old trends just accelerated.
Lucrative and fulfilling.
The vision I've got is to standardize these products.
Design, build, own, and operate.
We have 65 people in the room.
We got an important message here to the world.
We can put a guy on the moon, but our water is horrible.
Recycling all that water, it's a huge impact for the environment.
Bringing new infrastructure in to drive growth in America.
That's a critical part of the picture.
It's a twin 125 gallon per minute RO system.
I don't think we're talking about a $10 million fund. We're talking about a series of $10 million.
Yeah, the opportunity itself is very big.
Yes. Take care of the water.
Not too many CEOs do a weekly briefing and are willing to talk to individual investors.
And good evening, everyone. It's a pleasure to be on board for another CEO briefing. They never get old. First of all, it's always something we can say and talk about. We seem to have a lot of news all the time. And in addition, we have some special news about the annual results from last year. As you know, we had some really amazing things happen last year, but you know, in the real world, these things have a lag, and I will show you exactly how these numbers play out. So with that, I'm going to just run through a couple of the numbers here. All right, so it is Thursday, the 7th of April already. And okay, so it's an inflation-friendly asset class, but it so happens to be, and I'll be discussing this further, it's an income-bearing asset. And in this environment, income-bearing assets are probably the safest thing there is. But they have to be at the bottom of their run. They can't be maxed out. Look at commercial real estate. It has very high valuations, and it's only going to come down from that because New York is now running at 30% occupancy rates on offices. There's literally half as many people coming to work as used to, which is a dramatic drop. So all kinds of assets depended upon revenue assumptions that were based upon, people showing up in offices, people, walking down the street and getting a bagel and so forth. Those times have changed. So new era, and what you need is an asset that will always be needed. Number one, will always become more scarce, and is currently just beginning its run. This is the exciting part about it all. And we'll be talking about that further in our freewheeling discussion later. But meanwhile, of course, as you know, we do our very best to tell you how it is, and we fix it as we go. We try to be the most transparent public company on the planet. All right, speaking of which, the numbers we filed this morning, if you go into Edgar, which is the SEC search system, you will find our annual report. Now, this was, as you know, it was due on the 1st, and there's a standard 15-day extension you can take. We took it, but then we only required, I think, 5 days of it, 5 business days, I think it was. So, actually incredibly good performance by the team, given the complexity of our systems, and it's going to get even better yet. All right, so let's get right down to the numbers. First of all, let's take a look on fiscal year 2021 versus 2020. Sales were up 40%, which is fantastic. Now remember that generally accepted accounting procedures, GAAP, require what's called revenue recognition, which is based on completion, milestones. And so you might have a big sale, but then you've got to recognize it, right? So sales were, as I say, up 40%. So we were typically a $4 million business. Literally in 2020, it was 3.9 million. and it popped up, which is great. Revenue was up just 1%, so basically flat. Did not yet reflect those changes. In fact, gross profit was down. Now, operating losses are showing a dramatic increase in selling and marketing expense because we are in the process of dramatically increasing our burden to build capabilities for water on demand. Much of it is selling and marketing, but general and admin expenses remain relatively unchanged. Okay, now another thing to remember is we have to mention this highly fictional number called net profit and loss, 13 million in 2020. But that's all what's called derivative calculations. It relates to how our liabilities are recorded in any given year versus the stock price, et cetera. And it goes up and down. There's no rhyme or reason to it. I don't understand it. The bottom line is that we go back to basically we're still operating on a loss, about $1 million a quarter. But that is on purpose. Our operating divisions are profitable. It's our efforts to create this brand new thing that is costing us money. And that's a decision we took a little while ago to go all the way and create a big industry success. So that's kind of how it is. Okay, now here's the interesting part, quarter versus quarter, all right? And that is, we had a dramatic increase here. We doubled between Q3 and Q4. We doubled from sales, to over $2 million. So that was fantastic. Revenue was up 16%. Gross profit was down, but that was just a factor of, again, just timing of jobs. And losses from operations. In this case, it's relatively unchanged. Looks like, of course, we still have losses, as you can see, but the sales and revenue are working their way up. Now, in 2021, we booked orders for more than $12 million compared to 4.2 million in 2020, which is more than 3 times as much. So here's what it looks like. Orders are up 300% for the year, sales 40% up, revenue just up 1%. But as you can see, it starts to show in the last quarter, 202% in sales up and 40% for the last quarter. In other words, what we believe is there's a potential for greatly increased revenue over time as the orders turn into sales, turn into revenue. And that's how it looks. And there will be a release about this, but I wanted to give you the early numbers. We're happy with how it's going. Now, because these orders boomed so much, we had, a story here where Progressive Water Treatment, they booked a huge amount of business and they had a short-term cash flow requirement. And so we went ahead, and this is the first investment we made out of water on demand. And here's the letter that describes it. It just went out today to 4 investors. And basically, it tells a story about Progressive Water Treatment, dramatically increases sales. One job alone was $5 million as an order, right? And they had a brief cash crunch, short-term loan, $150K, and we went ahead and the board approved the loan with security and monitored, and very high interest rates, 15% per annum for the first 30 days, and it pops to 23% for the next 30, right? Not too shabby. We don't mind making that kind of money. Progressive repaid within 57 days, and there was about a $4,000 interest payment. And the investor here receives their share of the 25% net profits distribution. And because it was such a small amount, we didn't deduct anything for, administration or operations or anything like that. We just took the total interest because it was small enough as it is, and just gave them 25%. So went ahead, we sent it today on a automated clearinghouse. And of course, now they are doing fine. We were like, do you want more loans? And like, no, we're fine. We don't need these 23% deals. Not needed. Thank you very much. It's like credit card rates, right? So they are now fine, and we're focusing on our real job, which is to invest in these pay-per-gallon projects with the $1 million dedicated in our program. So it's kind of like framing that first dollar on the wall. It's kind of cool. So we thought it was worth doing. Not a heck of a lot of money. It was like $1,000 total paid out, but symbolic. Okay, in an interview that I gave with Business Insider this week, they basically wanted to know, so what is the, how are water utilities going to do? Meaning municipal bonds, the very large water companies that operate water systems on contract, people like Veolia, American Water Works, Evoqua, and so forth, Suez, all these companies, how are they going to do? And I said, generally great. Only problem is that they're going to suffer because all stocks are going to suffer. And furthermore, there's going to be a problem with inflation. Is going to, anytime you deal with something that consumers consume, you have a problem with, let's say, well, we saw that with landlords, right? Tenants got forgiven their rents, but the landlords were high and dry, and a lot of them were small, and they suffered tremendously. There were tremendous amounts of defaults by landlords. Why? Because the government wouldn't let certain things happen to consumers. And I believe that this is going to happen with water rates, that they're going to be capped out. There's going to be a limit to how much these vast, large water companies can make. But, this says you really need to be not in a stock, but you need to be in an asset that bears income. And of course, an asset class that is not maxed out. So in this interview, this is very important. We're going to play it. It's a very short interview, but basically, risk assets are in danger because the Fed is going to try to pop the bubble. And that's where you really want to be. I remember in the mid-70s, you could get a house in Orange County for $40,000. And I was like, wow, that's a lot of money. Very funny. So you want to start at the beginning. If I bought back then, then I'd have multi-million-dollar homes for the same thing. So that tells that story. So let's go ahead and play this, and we'll take a look at this little clip.
Define the difference between Volcker and Brainerd inflation. What's different with this 7-8% versus a 7-8% when you were certified at Berkeley?
I think the difference is that the inflation that Volcker had to fight built up over a long period of time. And so inflation expectations started to rise pretty significantly. So it's much harder to get rid of the inflation than the inflation we have now. The good news is that the inflation expectations are still relatively well anchored. So that would imply that the Federal Reserve isn't going to have to do quite as much to push inflation back down.
Your line in your piece this morning in the lead paragraph, Bill, I think has got everyone's attention, so I'll repeat it for everybody who hasn't heard it so far. To be effective, it'll have to inflict more losses on stock and bond investors than it has so far. Bill, run us through financial conditions and how you gauge financial conditions and why you might believe that stocks are a big part of that.
Well, financial conditions are important in the United States, and Chair Powell has emphasized this in his prepared remarks because that's how monetary policy works. The U.S. economy doesn't really run on short-term interest rates. It really runs on long-term interest rates, and the stock market is also important because a lot of people have exposure to the stock market, and the level of the stock market affects their wealth. So the Fed has said pretty clearly we need to tighten financial conditions to slow the economy down to keep inflation in check. And so far, financial conditions really haven't tightened very much. The stock market is only 4% or so off its high. It's still up very sharply from where it was a couple of years ago. And bond yields, 2.5, 2.6%, are still really low, especially when you adjust for inflation. So in my mind, the Fed hasn't really accomplished much yet. And if financial conditions don't cooperate with the Fed's going to have to do more until financial markets do cooperate.
Bill, talk a little bit about the consequences of this. If stocks are a reflection of sentiment, if they affect the way that people are willing to go out and make purchases based on their household wealth, what does that do to the economy? Are you basically saying that if things continue the way they are, the Fed is going to have to torpedo growth to a potentially recessionary degree?
Well, the Fed right now is, markets are pretty confident in the Fed's program because they have the Fed taking the short-term rates up to about 3%. That causes the economy to slow, and then the Federal Reserve eases policy in 2024 and 2025, and we have a soft landing and live happily ever after. I don't think it's going to be that easy because the markets are so confident in the Fed, the financial conditions are still quite buoyant. If financial conditions are buoyant, that means the Fed has to do more to slow down the economy. Also, a soft landing is very, very hard to achieve when the unemployment rate is so low. The soft landing examples that Powell has cited, 1965, 1984, 1994, were all examples where the Fed tightened and the economy slowed, but did not slow sufficiently to push up the unemployment rate. The unemployment rate in all three of those episodes kept declining. I think in the current environment with the unemployment rate at 3.6% and wages running well above a rate consistent with 2% inflation, the Fed's going to have to tighten enough to tighten financial conditions enough to push up the unemployment rate. And when the Fed has done that in the past, it's always resulted in a recession. That's not their intention. They'll go for a soft landing, but their chances of pulling off are very, very low.
Do you think that rapidly reducing the balance sheet, Bill, will be enough to achieve this sell-off that you think is necessary in order to enact some of the tightening that the Fed is trying to achieve?
Well, certainly we'll work in the right direction. Obviously, quantitative easing helped pull down long-term yields, and I think as you reverse course, that should push them up. But we don't know by how much. We already know what the Fed's going to do, and markets haven't really moved very much. So, I think it's just a big wild card in terms of how much will the quantitative tightening do the Fed's job for them. I think the big point I would just make is just it's very unlikely that a year from now we're going to be at this level of bond yields this low and this level of stock prices this high, because that's probably not sufficiently tight financial conditions to do the Fed's job for them.
Bill, parse the difference as inflation comes down of the importance of goods inflation coming down versus service sector inflation coming down.
Well, obviously, both matter. I mean, I think where the Fed's expectation is that goods inflation will come down quite a lot over the next year, because the composition of demand as the economy reopens will shift away from goods back to services. And the fact that some of these supply chain disruptions, for example, in the auto sector, will gradually get resolved. And so car prices, for example, will be weaker, used car prices will be weaker. But the services sector inflation is going to be a lot more persistent, because that's really about labor costs. And we're seeing that labor costs are going up because the labor market is unusually tight in the current setting.
Bill, why don't Fed officials, when they're in the seat, talk like you just have now?
Well, it's unpleasant to be a Fed official and talk about how you have to tighten financial conditions to push up the unemployment rate. You don't want to talk about putting people out of work. And that's not obviously the deliberate goal of policy. The deliberate goal of policy is to keep inflation from getting out of hand. Unfortunately, one of the ways you have to do that is to generate enough slack in the labor market to keep inflation in check. And that's just an unpleasant conversation to have. So what the Fed officials talk about is how we have to keep inflation in check so we can sustain this economic expansion and keep the most number of people employed. And that's true, too. What they're not telling you, though, is how difficult that is to pull off.
I would say that I think they're smoking something if they think that they've tamed inflation. There's just way too much going on with other disruptions, geopolitical disruptions, et cetera. And also, I think that we're going to have problems with interest rates, et cetera. Long story short is, I don't think people should be, taking risks in, high value tech stocks, consumer goods, et cetera. Invest in, as I say, income bearing assets seems to be the only way to go. But we'll have that discussion shortly. I'm going to go ahead and play the very, very cool presentation that Ken made. And here we go.
All right, everyone, welcome back to Money Show's Virtual Expo. We are pleased to welcome Ken Behringer. He's Vice President of Business Development of the water technology company Origin Clear. Ken Behringer is a 30-year veteran in public and private equity and co-creator, co-strategist of Origin Clear's visionary and highly disruptive water on demand trademark strategy to help rapidly centralize the world's water treatment. Ken, thank you so much for being here. It's all yours.
Thanks for having me, and welcome and good afternoon. What I'd like to do is I want to get a disclaimer out of the way. I've got a terrible cold, so I may frequently sip some water. Otherwise, I won't be able to speak. But other than that, I'm excited to get started. The introduction kind of gave it a summary. What I'm going to try to do is lay out. We have something very special here, and I'm going to give you a high view. We'll probably have some questions that I'd like to leave time for. I'm going to give you a kind of a 2-year timeline and some milestones on how water on demand goes from a private asset-based subsidiary of Origin Clear that's financing water projects strategically here in the US alone to bringing it forward as a world brand with several hundred million in royalty bearing assets, generating potentially several $billion in annuitized revenue. So it makes us not only an attractive acquisition target, but it's a major multiplier of our market capitalization. And as a already publicly traded company, that obviously is exciting. Hopefully and logically, we would think that maybe it'd be some multiple of those assets that we are going to hopefully have done in the next couple of years. So to summarize this, and then I'll flesh it out for you, it's a securitized asset, water on demand, that throws off inflation defensive royalties, and it's wrapped in a FinTech envelope. And it's going to create, I hope, two separate potential capital gain plays within one opportunity. So I hope to accomplish in this presentation is just the highlights that we can fill in blanks on in more detail in more of a one-on-one environment. So that's my summary argument. Now I'll make my case. So water on demand, these decentralized modalities that we've had been sold for years. The real breakthrough was the ability to deliver those to those who need them as a private utility with no upfront cost, similar to what solar panels act as a private utility. So water on demand is the brainchild of myself and my fellow strategist, CEO Rick Zekelberry. Originally, the company was created in 2008, and we've incubated the water on demand vision much more recently. What we did first was we achieved the capability of utilizing patented modular decentralized water technology for businesses, basically delivering to their place of business to do their own water treatment. 80% of all water pollution comes from agriculture and industry. So that, if you fix it there, you fix it everywhere. Now, these capabilities, the innovation, the real breakthrough is delivering them now as a private utility with no upfront cost, just sign and go, okay? The prefabricated patented water system, they're good for almost all applications, but they're really beautifully suited for a bunch of the following that you can see here: craft breweries, housing developments, animal farms, mobile home parks, campgrounds, assembly plants, warehouses, golf courses. So our motivation was to create a world brand, was not to just entirely for wealth creation, but although the wealth creation potential is massive, it's also to solve a global crisis that many aren't even aware of here in North America. So we didn't want to stop with just delivering it to these businesses. We wanted to globalize it, and here's why. 84% of the world's water is consumed by agriculture and industry. Now, that makes up 4/5 of the planet's water, a planet's sewage rather, is dumped directly into water supplies with no treatment whatsoever. Most of agricultural, industrial, and commercial wastewater is not treated by your utility. Flush the toilet and it works. It doesn't work that way with industry. Public utilities are primarily set up to deal with household waste treatment. Businesses, as a result, spend billions of dollars every year to dispose of this wastewater. And anyone who's ever run a business knows that you'd much rather, if you have $1 million, you'd much rather deploy that capital to grow and expand your business, not use it as an effort to avoid being shuttered for being a violator. So what happens is action naturally was delayed, and billions and billions of gallons go untreated every day as a result. So then you hear the stories like Flint and Compton and South Bend. No, they end up being a symptom. The symptom, really, the disease is inaction. So what is the cure for that disease? Well, the cure is making water treatment like an oil well. We're going to duplicate the most profitable energy model ever conceived and transform the world's most valuable commodity. The most valuable commodity on earth right now is water, okay? And it's enabling that water to be treated anywhere with no upfront expense to whoever who needs it. And thus treatment doesn't get delayed, okay? And that happens now, right? Not only is water not trading, it's the only commodity that I can think of that's not trading at an all-time high. But this is the very first way for investors to be a direct funder and royalty recipient ever in history, okay? So this provides strong financial incentive to fund these systems for places that really need them. Now, I'm going to show you, hopefully demonstrate as an asset class, how water is within these systems, which are portable, much more stable than oil, with better inflation defense than real estate. And going back to energy, unlike traditional energy, which eventually is going to be sunsetted, this will never go away because it's required for all life on Earth, right? Before I get to that rollout and how we get there, I want to spend a second on how our unique capability allow for what used to have to be purchased, thus creating a pain point for businesses and often delayed action, can now be placed on site as a private utility, doing the things that large infrastructure cannot do because they can't be built to every location. And we can simply do this by dropping it on site and charging by the gallon. So the first phase of water on demand is already alive. It's a pay-as-you-go program. There's no big capital expense. And it transforms whoever makes these systems, us and many, many others, as I'll demonstrate. We go from selling high-end equipment to just blessing people. Here you go. It allows us to say, don't worry about buying the equipment, the $1 million. We own it. We're going to be your private utility that deals with your very specific effluent need, which is also makes it more efficient. Just pay on the meter. Now, their response generally has been, okay, great. Where do I sign? Think about how much business, anyone who's ever sold high-end items, how much you could sell if you didn't have to get the person who needs to spend $1 million to not actually have to spend it, right? They don't have to make that upfront investment. So that $1 million expense goes away. And that was delaying action, right? So now it happens without having to spend the money. So we prevent the delay. And we prevent the billions of gallons that would have gone untreated now are getting treated. So we keep the title to these systems, and we're creating an asset base that'll elevate us to a national exchange. So we own the assets, we own the contracts, and now we have a multi-decade relationship to the client. It's not a one and done. And it provides an incredible inflation-hedged royalty to the investors. Now, about the royalty, I mentioned it has major advantages over current traditional assets. And I'm going to explain that in a minute. But we designed it after a very well-known, very well-recognized, phenomenally successful model of the oil and gas master limited partnership. That was the kind of the spark of the idea, or MLP. So I'll get into the background on MLPs for those of you who aren't familiar, and then you'll see how it's a perfect fit for water. So many of you already know, and for those that don't, in 1981, Apache Energy invented the oil and gas limited partnership. So it allowed for any accredited investor to essentially partner with big oil and earn royalties on the continuous production of oil and gas, essentially for life. Now, because oil is an international currency, that's been a standalone favorite for asset and inflation protection almost since day one. It's preserved and protected trillions of dollars of wealth over the last 40 years. And that's what it did for the investors. What it did for the business was it allowed Exxon or Shell or whoever to tap the almost unlimited quantities of capital that were desperate to be preserved against long-term inflation. That's what it did for the investor. And what it did for the industry is it served it well. It didn't compete with big oil. It actually helped it tremendously by providing capital. So this is the MLP chart compared to the S&P. So inflation defense, wealth preservation, that's grown the oil and gas MLP market to about $300 billion a year space. Water on demand, as you're going to see now, has a lot of the inflation defense features of an MLP, but none of the drawbacks fossil fuel production has, right? Which makes it universally appealing to both traditional wealth preservation players and the trillions of dollars of eco-friendly capital that are looking for a profitable space. So if this is what MLPs could do versus the S&P last year, we have a lot of reason to believe that water on demand could potentially do a lot better. So you know the MLP model. Imagine that MLP model now for the continuous production of clean water. This will have the same real-time inflation protection as energy. Here's what it has that MLPs don't have, which makes it more universally attractive and much more stable. Every inch of ground it touches is cleaner and greener. So the humanitarian and environmental benefits of treating trillions of gallons of water are incalculable. But it's profitable too, right? So there's trillions of dollars out there in ESG and eco funds that can grow and preserve their wealth too, right? Without tremendous speculation of a developing technology, but they can still stay true to their mission. Okay, now, as I said earlier, water is much more stable. There's little to no water market price risk. So those of you who are in energy right now are enjoying these huge price spikes in oil. We know that that party can't last forever. Oil's always essentially at the mercy of global events and OPEC. But water prices, they rise every year very slowly, which I'll show you, but they're very steadily. There's no big up and down swings. It's always based on local water rates unique to that area. So it's largely, if not completely immune to international drama, okay? And thirdly, this is going to permit access for the very first time. Companies like the big Veolia, American Water Works, Evoqua, there's the multi-trillion dollars of water market that's currently inaccessible to them because there is no heavy infrastructure and there never will because there's no tax funding for it, especially in third world countries. I'll give you an example. A company like American Water Works spends $1 billion a year acquiring companies just to pace 10 or 12% annual growth. So a company like them acquiring our capability for a few $1 billion would open access to 80% of the planet that they can't operate in because there is no water infrastructure and there's no government spending to support it. So how we're now bringing this to the fore is we've got a $300 million fund. It's going to be now added to Manhattan Street Capital is adding our fund to their portal, giving us worldwide exposure to crowdfunding and family office investors. So here's how it starts. Let's say you have $150 million that goes into capital equipment, okay? That would create value of machines deployed about 450, so about 3-to-1 leverage. And it would generate about a little over 20 years, about just under $4 billion in total revenue, which is a wonderful annuitized type of asset. But it also creates about $904 million is what we project to the investors. So you're investing, let's say you invested $300 million in total as an investor class, and you're getting back triple that in pay streams, okay? Every nickel raised in this new asset class has immediate cash flow with asset securitization. So it's not this spray and pray. And I believe that this will begin a cycle of larger scale Wall Street funded micro utilities, very profitable to the investors. And I think it's going to stimulate rapid entry into this asset class. What asset investor is going to say no to ultimately receiving roughly 300% of their capital invested with real-time inflation adjustments? Plus, because it's owned by a public company, you're going to get a grant of 150% return on top in the form of the parent company stock, right? Then there's the real intent of also bringing Water on Demand forward as an entity someday. So there's the potential upside of being an early founder in that as well. So this stock that I'm referencing, whether it's the parent, some future iteration, it's all free. Okay, so there's the really potential unlimited upside, but without the normal capital risk. Remember, your capital is in a securitized asset, so principal goes there. And if capital gains are your motivator, well, there's certainly a lot here. But if asset, wealth, and inflation protection are important too, then this has the potential to outperform a lot of other asset classes, but having that outside capital gain potential as well. And we've set it up so investors don't just survive inflation, which we're all sensitive to right now, but actually thrive, okay? So a way to assure that the investors' assets and their pay streams grow faster than inflation, simple. We tie the pay streams to water rates. So water rates inflate at 3 times faster than core inflation, but water rates are very stable, okay? And as you can see in this graph here, the end users, we charge a utility rate somewhere well below that new water rate. In other words, $1 million a month water user would simply reuse that same water that they've already paid for and get multiple turns on the water and eventually discharging it. So it's not just water treatment, it's major water conservation. But the business, well, he's just saving a lot of money, right? And that may be his primary driver. Solving the financial pain point to the world's main polluters removes that barrier, okay? And that's how that works. Now, here's how we protect your pay streams regardless of what happens with inflation, okay? What we've created here is It represents the world's first direct investment in water assets, better price stability than oil, and more inflation protection. Every single dollar, oil works directly with inflation, water actually outperforms inflation. Every single dollar of investment in water on demand can be ultimately directly linked to a number of gallons of water that those dollars were able to reclaim and reuse. $1 million investment in water on demand will be responsible for 175 million gallons of new clean water. That's the definition of impact investing. Now, because of this, there are trillions of dollars out there, ESG, eco funds, that will have the benefit of knowing what kind of an impact with each dollar that they bring to bear, okay? And eventually, number 5 here, water on demand becomes a pure play. It allows every quality water company and manufacturer to be a service provider. Essentially, the entire world is our manufacturer, the entire world is our sales agents, and so on and so forth. And it's a model that's far more profitable than the simply build and sell model. Now, imagine the power of dramatically expanding $1 trillion industry like cellular did to telecom. And that's what we think that this can do. But you also have a securitized asset that grows faster than inflation. Now, you combine those ideas with decades of real-time inflation-adjusted yields. Those yields are actually fixing water with every dollar that it's necessarily protecting from this looming hyperinflation that we read about. And let's talk about inflation for a minute. The true CPI right now, this is your consumer price index. This is the number the government reports. I think last month was 8%. They ended the year at 7%. The true CPI right now is the blue line here. This is from Shadow Stats, and that's my source. The government numbers of 8% or whatever are nonsense. We're probably 15 or 20%. Best case scenario, if it doesn't climb higher, 20% for several years, meaning savings will be obliterated if no action is taken. But we're seeing a pattern here of repeating of 1981. If that happens, we could be looking at, if the government number is 36%, the real number is 56%. By 2026, that's not a far off date here. So this becomes not just an investment that you turn some of your aggressive money into potentially a lot, or do something that you feel good about because it's environmentally beneficial. It is all that, but it's much, much more. This becomes where you allocate what you've earned in your life that you don't want to be evaporated over the next few years for the previous mentioned reasons. And it's a chance to outpace inflation and what's coming in real time. Water rates run 3 times faster. Okay, so no one's rooting for hyperinflation. None of us want this to happen, but not addressing it means that you risk throwing that money kind of to the wind, and this prevents that. So tying the opportunity together, given what an all-around solution this is on both the application to water and as an asset class to investors, this world brand, believe me, we're fully aware that it deserves to be its own pure play.
And with that, I'm actually going to hold this because I think it gets into the details of the offering at this point. And I would like to spend a little bit of quality time with our good man, Ken Behringer here. So Ken, pop your video on and let's get with the free flow.
I lack the power. Hang on.
You know what? That's my bad. 1 second. Let me add you as a co-host.
Nobody puts baby in the corner. Come on.
That's to prevent you from popping in, There you go. Like, control the man, please.
All right.
Voila.
We're closing everything. I'm good.
Oh man, tell you.
Sorry.
He's
How are you?
Zoom formal.
Yes, I am. So and I'm glad you cut it off there. That was kind of a high view at the Money Show, and it's so funny because things have actually evolved and accelerated so much since then. I'm looking at that and I'm thinking about
forget this thing.
Like what? No. It's all there. But there's this whole new trunk of stuff that, God, I wish I had a chance to talk about it then, right? But we were probably a couple of weeks. That was like before the summit and stuff like that, and kind of the manifestations of what came out of that. But it was interesting to watch that. We've been yelling from the mountaintop about assets being the way to go and water being the greatest asset ever, and decentralized water, like all these terms that no one had any idea about. And all of a sudden I'm seeing all these validation articles on how water is the next great investment. I'm like, see, I told you, you feel validated, but you almost feel frustrated. You wish people had kind of had that come to Jesus moment a little earlier before they were buying into a lot of these bubbles. I read I keep sending you all the, zero hedge doomsday stuff at like first thing in the morning, like, good morning, here's how the world is ending today,
Right.
Well, because there's a lot of doom and gloom on the financial side of that. And they're saying that Powell needs to kind of wreck the market and wreck the housing market in order to bring, like kind of bring inflation under control. That's a little drastic. I thought maybe not printing 17 trillion would have helped.
Yeah, they say he was saying that it's going to be relatively easy bringing down inflation. I think that's a pipe dream.
Okay.
I think it's a pipe dream.
Right. Yeah.
But anyway, look, we know inflation is a fact. We know that if you are in any one of these maxed out investing classes, you're in for a big surprise. And so tell me a little bit about why you're having such success right now getting investors into water on demand. He goes, how much am I allowed to say?
Right, what am I allowed to say? Okay. I would recommend that folks that want a detailed kind of rollout strategy reach out to me personally. This vehicle, this entity, of course, needs to be its own identity, its own thing. Okay, so
what we call a pure play, right?
It's a pure play. It's a fintech pure play that's wrapped around what could be $1 trillion asset class.
Now, why is it a fintech pure play?
Well, it's fintech because really all it is it's all right. So I'll make because people don't understand.
Because you just signed up for the Wharton extended course on that.
Yes, I'm going to be a Wharton graduate. Okay, so yeah, I've signed up for the Wharton Business School course on both fintech and actually there's cryptocurrency in there, which I wasn't my reason for signing on. It's funny. I knew fintech before I knew it was fintech, right? In other words, you and I dreamed this thing up, and I was verbalizing it in lay terms, and you were like, "That's fintech," right? So in other words, I guess I intuitively understood what fintech was without having the formal educated access. The way
which Wharton is going to fix for you. Thank
they're
God.
going to fix me up good, right? I'm going to come out very stuffed shirt.
But the fact is that we are unique in the water industry. There's no one else doing only finance. No one else.
So how is it fintech? So yeah, you got to that. So so how's this fintech? Since they don't understand the mechanisms that are going on in this head, I say, look, Airbnb owns zero real estate. They don't own a doghouse. They're $100 billion valuation. All they do, they take your money, they facilitate the payment of your credit card to me to rent my property. Neither one of us have to even meet.
Right.
And you could do that in Israel, and I'm in Argentina, right? So it creates this entire mesh around the planet, which allows the rapid movement of money. I can buy properties in Montana all day now, never lay eyes on them, and have them rented out as soon as the damn thing closes, which I do by e-sign. This creates electronic real estate, funding, financing, renting, that sort of thing. So that's what Water on Demand is. It allows an end user in Montana to receive a system that he can't afford. It's deployed by an investor who then becomes a partner with Origin Clear, or Water on Demand, in this case, Water on Demand. It becomes a royal partner for life. So that's fintech. That's financial technology. And basically, it's, they process his ACH payment. The investor gets that ACH payment. That's the down payment. That's his first month. Boom, he gets that. And then as this meter runs, and as these revenues, as this monthly bill is accumulated, a quarter of it is immediately shunted off to the ACH accounts of the investors. And because, look, water is super stable and super safe in a way that real estate or oil and gas can never be. But because we're going to set these up as funds, you will have a variety of properties with a diversity of properties within the
It's a
fund
basket.
itself.
Yeah.
Right. So maybe the really, really nastiest water out there in a super dry area, that thing is gonna blow out tons and tons of cash. Whereas something that maybe is much more moderate effluent, used in a much more water-rich area where water rates are low. So in other words, you don't have to be the guy who buys a strip mall in Baltimore and it's boarded up. Well, it's boarded up, right? You could buy a REIT. You could be part of a fund that owns 1,000 properties. That's just one. That's a total non-performer, right? But the high rise, somewhere is performing beautifully, right? So and now obviously we're not subject to the same risks as as commercial real estate or oil and gas, because we don't have that. We're not at the mercy of international turmoil, right? It's all immune from that. But still, some forms of water treatment are going to be a richer revenue source than others. So what we're going to do is we're not going to stick Mr. Jones with this super high payer and Mr. Smith or Ms. Smith, excuse me, with something that reduces the lower. And the reason we can kind of estimate these things very accurately is because the portfolio will yield X based on 25 years of our operating history.
Okay,
and that's exciting.
Yes, and there's a great book, and we're going to wrap this up because we're at 10 till. But there's a great book that I'm a big evangelist for, which is last week I talked about 3 books, and this is the 3rd book, right? The 2nd book was the Innovator's Dilemma, and of course the first one was Inside the Tornado. Well, the 3rd one is called Focus by Jack Trout, the guy who was part of the team that created the whole positioning revolution. And one of the things he says is, to achieve focus, you've got to have sacrifice. They come together, right? Okay. The same coin, the face of it is focus, the reverse is sacrifice. You have to give stuff up to be focused. In our case, the normal, what the water industry is doing is they're doing these same operation and maintenance things, keeping it all.
Right. It's very parochial. It's very parochial. Exactly. I get 100% of something, right? When you could
it's
have
not scalable. What we've learned, and is I've learned from experience since 2015 with progressive water treatment. What we've learned is that there's a lot of work involved in these projects. It takes months and months to get them bid, and if the margins are low and it's a slow business, so how are you going to blow it up? How are you going to create the kind of expansion that our investors expect? Just don't do that. Just shop it out.
That's right.
And do the high turn, high profit stuff, which is the
that's right. That's right. And you know what? Ask any guy who's trying to compete out there if they could have access to a modality that would make it lighter, cheaper, more durable, and make it a superior product. Tell them that they can have that. Oh, by the way, and we'll supply the money. So that that guy you've been dancing around with for 3 years. This is a conversation we had, Riggs, on the phone with so and so. The guy you've been
absolutely that golf course deal.
Just tell him, don't worry about it. I got the money. And you know what he's going to say? Oh, okay, right? It was that Hollywood thing you said that day. It was the same thing. If I brought the money, then you could do whatever you want. So this is the thing,
which is why the ugly girls, the ugly guys in Hollywood get the chicks. They got the money.
They got the money, right? So the end result is that what we've done is we've broken that parochial mold. We've turned this into. Look, the benefit of you and I, neither of us being in water, is when they said you have to do it this way, we said, no, you don't. And, and that's that.
We challenge that. Yeah.
I also want to next week, remind me to mention, I went on a land search this weekend. I was looking at tracts of rural land, and you'll never guess what the problem was with most of these properties.
It's the water, stupid.
It's the water, stupid. Right. Yep. And we'll talk about that because it involves major land developers. People, they're building thousands of homes well outside the
We are going to do that next week, my friend. Yes. So hold that thought.
I'm going to hold that thought.
Now 8:53 p.m. Eastern. Okay. And I have my beauty sleep ahead of me, right?
You better get to bed early.
I'm just going to show quickly the contact screen here for you guys and gals to talk to Ken. You know the drill, but here is the information. You can email, you can book the call just to us, oc.gold/Ken in your browser, or give him a call. He is an absolute whiz at this, and really he deserves better than to work here, but we're very grateful.
I'm going to call my agent. All right. Get my agent on the phone, Amanda. All right. Guys, it was lovely speaking with all of you. I hope you got something out. Now there is, I can drill down with you folks. So please reach out, call me, book an appointment with me, set aside some time, and I'll fill in the blanks for you.
Good. Thank you very much, everyone. Thank you for all you do for us, and we will catch you next week. I guarantee you it'll be exciting. We'll be getting into the real killer app for water on demand, which is housing developments. Bada bing, bada boom. Have a good night all. Take care.